Mastering corporate-level strategy, diversify your way to success. Corporate-level strategy is the cornerstone of any thriving business. It determines the actions a company takes to gain a competitive edge by managing a group of businesses in different markets. More than just growing revenue and profits, a well-crafted corporate-level strategy helps businesses explore new opportunities, maximize value, and navigate complex market dynamics. For African business leaders, understanding and implementing effective corporate-level strategies is key to driving sustainable growth across diverse industries. Before we dive into the specifics, don't forget to like this video and subscribe for more insights into leadership and management tailored for African professionals. Why corporate-level strategy matters? At its core, corporate-level strategy answers two critical questions: where to compete. It identifies the industries, markets, and product lines where a firm should operate. How to compete. It defines how corporate headquarters manage these businesses to maximize value. Whether you're steering a family-owned business in Lagos or leading a multinational firm in Nairobi, crafting a thoughtful corporate strategy can mean the difference between thriving and just surviving in competitive markets. Opportunities for stories and anecdotes. Story 1. The conglomerate success story. Share how an African conglomerate, like Dangote Group, diversified from cement production to food processing and petroleum refining. This story could illustrate how strategic diversification transformed it into a market leader. Story 2. A struggling small business. Discuss a small business in Addis Ababa that diversified into tourism services during an economic downturn, ensuring its survival and growth. Story 3. A cautionary tale. Highlight an African mining company that over-diversified, losing focus on its core competencies and eventually needing to restructure. Levels of diversification. Firms can pursue different levels of diversification based on their goals and resources. Low diversification. Firms focus primarily on one business area, generating 70% to 95% of revenue from a single business. Moderate to high diversification. These firms venture into related markets, sharing resources and core competencies across businesses. Very high diversification. Firms adopt an unrelated diversification strategy, operating in multiple industries with no apparent connection. Snippet for rationalization. Consider an agriculture business in Kenya expanding from coffee farming to flour exports. By leveraging shared supply chains and market knowledge, the company achieved economies of scope, transforming itself into a global competitor. Reasons for diversification. Companies diversify for various reasons, including value creation, sharing resources, developing core competencies, and gaining market power. Value neutrality, adapting to antitrust regulations or addressing uncertain future cash flows. Value reduction, managers sometimes over-diversify to secure their compensation or reduce personal risk. Example, an Ethiopian textile firm expanded into garment manufacturing to create value through vertical integration. By controlling both production and distribution, it gained a significant competitive edge in local and international markets. Creating value with related diversification. Firms pursuing related diversification focus on operational relatedness, e.g., shared activities like supply chains, and corporate relatedness, e.g., leveraging core competencies. Snippet for personalization. In South Africa, a logistics company shared its distribution network with a newly acquired retail chain. This operational relatedness not only reduced costs but also improved delivery efficiency, boosting profits for both businesses. Financial economies in unrelated diversification. Unrelated diversification focuses on creating financial value through efficient internal capital allocation. Corporate headquarters distribute resources across businesses to maximize returns. Restructuring assets. Firms buy underperforming businesses, restructure them, and sell at a profit. Example, a private equity firm in Morocco acquired struggling small businesses, revamped operations, and sold them for significant gains. Incentives and resources driving diversification. Incentives, external, antitrust regulations and tax laws. Internal, addressing low performance, reducing risk, and leveraging synergy. Resources, tangible, physical assets like plants and equipment. Intangible, flexible resources such as managerial expertise and technological know-how. Opportunity for a story: a fintech startup in Rwanda used its robust IT infrastructure to diversify into mobile banking, catering to underserved rural communities. Risks of over-diversification. While diversification can drive growth, over-diversification may dilute a company's focus and lead to inefficiencies. Snippet for personalization. A mining company in Zambia diversified into unrelated sectors like hospitality and real estate. Lacking expertise in these areas, it faced mounting losses and eventually had to sell off non-core assets. Final thoughts. For African leaders, corporate-level strategy is about aligning business goals with market opportunities. Whether you're aiming for value creation, market power, or financial economies, the key lies in strategic planning and execution. Remember, diversification is a powerful tool, but it must be wielded wisely. If you found this video helpful, hit the like button and subscribe for more leadership and strategy insights tailored to African professionals.